For years, the default advice for long-term investing has been pretty simple, right? Just buy an S&P 500 index fund and let it ride. But as we look ahead to 2026, is that really the smartest play anymore? After a fantastic run, there are some signs of fragility just under the surface. So the big question for this explainer is, can we use data to build a smarter, more resilient portfolio? One that not only weathers the storm, but actually beats the market? Okay, let's dive in. All right, so here's how we're going to break it all down. First, we'll look at the market's weird paradox right now. Then we'll get into the actual data on how you can beat the S&P 500. From there, we'll build a portfolio, piece by piece, starting with a solid core and then adding a really powerful thematic twist. We'll wrap it all up with a practical checklist to put this plan into action. And finally, we'll ask what set and forget really means today. So let's kick things off with the big picture, the 2026 market paradox. We've been in this strong bull market, but a lot of experts are starting to see some cracks in the foundation. And that really leads us to the central question we've all got to ask ourselves as investors. On the surface, things look great, especially after the returns we saw in 2025. But what's actually happening underneath it all? Now, check this out. This quote is from BlackRock, one of the biggest asset managers on the planet. They're calling the market somewhat fragile. When a giant like that uses language like fragile, you pay attention. It's a huge signal that the big institutional investors are feeling a little uneasy and maybe see some complacency creeping in. So what's making things so fragile? Well, experts at firms like State Street and BlackRock are all pointing to these four key challenges. You've got inflation that just doesn't want to go away, unpredictable moves from governments and central banks, the massive game-changing force of AI, and, global economies that are all kind of marching to the beat of their own drum. This really shows why the simple, old-school approach might not be enough anymore. Okay, so if the standard playbook is getting a little risky, we need a new one. And that brings us to our second section, moving beyond the benchmark. And the good news is, the data shows it is absolutely possible to do better than the plain old S&P 500. So here's the crucial point. Just because you're a long-term passive investor, it doesn't mean you have to settle for average returns. It's really time to rethink what passive investing can be and look at the strategies that have a proven history of outperformance. And here it is. This is the aha moment, right here. This data from S&P Dow Jones is just incredible. It shows that over the last 15 years, strategies that focus on specific factors, like quality or momentum, have seriously beaten the regular S&P 500. Just look at that top line. An index of quality companies with strong free cash flow has outperformed by 3% annually. I really want this number to sink in. 3%. Now, that might not sound like a ton, but an extra 3% compounded every single year for decades, that can be the difference between a pretty good retirement and a truly wealthy one. It's a massive game-changing advantage. Okay, so we know why we should look beyond the benchmark. Now let's get into the how. And it all starts with building a resilient core for your portfolio, a real foundation of strength. This right here is a classic, battle-tested portfolio structure based on recommendations from J.P. Morgan for weathering volatility. It's a 60-30-10 split between stocks, bonds, and alternatives. This isn't about chasing the hot new thing. This is about building a foundation that can handle whatever the market throws at it. So let's look inside that 60% slice of stocks. J.P. Morgan advises being selective. You want to focus on quality U.S. large-cap companies, especially in sectors like tech, financials, and utilities. But, and this is key, don't forget about the rest of the world. Adding international stocks from both developed and emerging markets can give you crucial diversification and get you access to some much more attractive prices. The other 40% of our core portfolio, that's all about playing defense. Think of core investment-grade bonds as your primary shock absorber when the market gets choppy. And those alternatives, like infrastructure, can be a fantastic hedge against that stubborn inflation we were talking about earlier. All right, with that super resilient foundation in place, now we can get a little more targeted. Let's add a layer of thematic growth. And for 2026, there is no bigger theme out there than artificial intelligence. This quote from Morgan Stanley just nails it. They see AI not just as some hot tech trend, but as a fundamental driver of productivity and economic growth for years and years to come. This is a wave you definitely want to be riding. But here's the twist. This digital revolution isn't just happening somewhere in the cloud. The unbelievable amount of computing power that AI needs is creating a massive, real-world physical demand for something. And that demand boils down to one simple question. How in the world do you power it all? All those data centers, all those processors, they need a staggering amount of electricity. And this is where a really cool secondary investment theme pops up. Well, according to some great analysis from the Motley Fool, a key solution to AI's massive energy problem is nuclear power. It's clean, it's reliable, and it can generate the huge amounts of power that are needed. This slide shows 3 specific ETFs that give you different ways to play this trend, from broad exposure to uranium miners to a more focused play on utilities that might even pay you a dividend. Okay, so the portfolio strategy is set. Now, let's get practical. Let's move from theory to action with a simple checklist to get your entire financial life tuned up for the year ahead. We've taken J.P. Morgan's detailed guide and boiled it down into 3 clear, actionable steps. First, optimize your accounts. That means maxing out your tax-advantaged retirement contributions. Second, boost your tax efficiency with smart moves like tax loss harvesting. That's where you sell losers to offset gains. And make sure you're up on any recent tax law changes. And third, secure your legacy. Plan your gifts, review your documents, and have those important money talks with your family. And there's one more crucial tip from their list that we absolutely have to talk about in today's world. Be cyber safe. As you get your financial house in order, just remember that the bad guys are using AI too. The rise of these super sophisticated phishing and deepfake scams means protecting your data and your assets is more important than ever. And that brings us to our final section, circling all the way back to our title. What does set and forget actually mean for a long-term investor in today's dynamic world? This slide clarifies the whole philosophy perfectly. Set and forget means you're not panicking over the daily headlines or making emotional trades. You're trusting the solid, long-term strategy you built. But, and this is a big but, it does not mean you never look at your portfolio again. You still need to rebalance, you still need to pay attention to major economic shifts, and you still need to do that annual financial checkup we just talked about. It's about strategic patience, not total neglect. And so, we'll leave you with this final thought. We've built a portfolio based on the best data and analysis we have for 2026. But the real challenge, and really the secret to long-term success, is how you'll maintain the discipline and the awareness to make sure that this is still the right portfolio for you a decade from now.